people are moving their money from these regional banks to other banks, or from smaller banks to banks where they're able to get higher yields in their savings accounts if they have those savings. If you need consistent new investors to pay your old depositors, otherwise you're going to go out of business and you're going to fail, it means you're a Ponzi. Your money is not in the bank. When you put your money in the bank views your money as a liability, not an asset. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today we are talking about potential banking failures in 2024. Now, time I'm filming this, it's the end of May. On April 26, about a month ago, there was the first banking failure when Republic First Bank, not First Republic that failed last year, but Republic First Bank became the first banking demise of 2024. And it's got a lot of people thinking about the fact that there's a potential of a lot more banking failures. So in this video, what I want to do is talk about what could potentially lead to banking failures, what are really the dangers, what banks are at risk, and what you can do about it to protect yourself. Because for some people, this means more than others. And ultimately, I want to give you complete transparency of what is going to lead, based on the research that I've been doing, what's going to lead to the potential banking failures here moving forward in 2024. And I think the potential for more banking failures is extremely high. So without further ado, let's just get into what my research kind of revealed to me, and I want to share it with you. All right, so the first reason that I think banks are going to fail more in 2024 is because of the fact that we're living in this elevated interest rate environment. Unfortunately, because of these elevated interest rates, a lot of people don't realize the negative consequences that negative interest rates, or that higher interest rates, have on the banking structure, the banking infrastructure. Now, there are 5 reasons that elevated interest rates actually have a negative impact on banking performance, and they put more stress on the balance sheet of the banks, which obviously leads to higher potentials of banks going out of business. And so the first reason is because when interest rates go up, the functionality of a fiat currency system and the fractional reserve system as we have it is that the Federal Reserve has the ability to raise interest rates to pull money out of circulation. When inflation gets high, they raise interest rates, they pull money out of circulation, and basically what that means is this is going to slow down borrowing. And if we think about how banks make their money, when cost of borrowing goes up and people start borrowing less, what happens is that makes it so the banks are making less profit. People are just kind of sitting on their hands or sitting on their money. There's too much uncertainty, and people are uncertain about what they're going to be doing here moving forward, and so the bank is not generating any new money, and that's causing a lot of problems. Now, the second reason that high interest rates are causing problems is because it's leading to, once again, less cash flow available for people. It's putting more stress on businesses. It's creating more uncertainty in the economy, and people are kind of, once again, sitting on their hands, and they're not spending as much money. Debt is getting higher. The cost of that debt is getting higher with people that have had variable interest rates with items like HELOCs. A lot of people got these home equity lines of credit, for example, just as one use case. Revolving credit lines for businesses, same situation. They had them in that 2 to 4% range, but now they're at the 8 to 9% range. And the cost of the interest alone has caused a lot of stress. And so what's happening now is people are defaulting, which is obviously leading to more of a cost for the banks. That's part number 2. Now, part number 3 is that people are moving money from banks to other banks that have higher yield savings accounts. When banks are relying, especially these regional banks, they don't have the highest savings yields, right? The high yield savings accounts that people are flocking to in the 4.5% to 5% range right now, they're typically not at these banks that are failing. So, and the reason is because what happened is these banks that have invested in short-term bonds or long-term bonds, they invested in at lower rates, and so they can't really afford to pay out the high yields, right? It's the banks with the newer investments that are able to pass those benefits along to its account holders, right? And so when you look at the fact that that people are moving their money from these regional banks to other banks, or from smaller banks to banks where they're able to get higher yields in their savings accounts if they have those savings, what that does is, on top of the fact that people are defaulting, on top of the fact that people are not taking new loans at higher rates to create more profit for the bank, and then they're moving money, it basically creates a lot of stress with these withdrawals on these banks that is really causing a ton of stress. And so that gets me to point number 4. And another reason that people are removing the deposits is because a lot of people had money in bank accounts, in savings accounts, even if they weren't making a lot of money, because of the fact that bond rates, CDs, other fixed assets were not getting good returns. So it didn't make any sense to put money into a bond that would tie your money up for years at a time at lower interest rates. But now some of these bonds have come up to 5.5%, 6%, 6.5%. And so now people have pulled their money out of the savings account that they don't need access to really right now, and they've put it into these bond portfolios. They put it into actual bonds with different companies, or the treasury bonds. So as this opportunity for investors and savers to go out and put their money in bonds with this higher interest rate environment, they're pulling the money out of banks. Once again, that's putting stress on the banks because it means less money on their balance sheet. And people don't realize it, but these banks require new deposits to be sustainable. It's one of the reasons I think it's kind of a joke. The banking system, I always say, is self-admittedly a Ponzi scheme. Think about it. If the banks need new deposits to be able to be sustainable, that's a Ponzi scheme, right? If you need consistent new investors to pay your old depositors, otherwise you're going to go out of business and you're going to fail, it means you're a Ponzi scheme. And I don't know how nobody sees it, but the elevated interest rate environment is exposing the banking system for exactly what it is. Now, reason number 5 that the higher interest rates are hurting the bank, on top of the fact, like, all right, we'll get rid of the Ponzi scheme thing. We'll not even talk about that anymore. I just had to get it out of my system. But the next reason, it's another element of bonds and the negative impact that bonds and the elevated interest rates have had. Not only is our depositors removing their money from the banks and putting their own money into bonds, but the problem is banks are losing money because banks invested in bonds at lower rates, right? That's what they did. And now that the rates have gone up, the bond portfolios that the banks have actually invested in have lost money, right? And so that's a problem. So the first reason, just kind of recap, that banks are going to fail, more banks are going to fail, is because we're living in this elevated interest rate environment. I'm not seeing any time that interest rates are going to go down. I know a lot of people are talking about Jerome Powell and the Federal Reserve reducing interest rates because they have to and all these things. But I think we really run the chance of inflation getting out of control again if they lower rates. And I think for the past 6, 7, 8 months, there's been a lot of talk about the Federal Reserve lowering rates. And every time they get to it, they don't lower rates, because when you look at the economy, there's so much data out there that shows we cannot lower rates, that we need to go through this. If anything, we need to increase rates because inflation is still not under control. Remember, the Federal Reserve, when we think about this, well, actually, let me say this. Reason number 2, on top of the fact that interest rates are going high, reason number 2 that more banks are going to fail is because we have this fractional reserve banking system. And what does that mean? That means your money is not in the bank, right? When you put your money in the bank, the bank views your money as a liability, not an asset, because they are owing you money. I've done a funny short on this video, or a funny short video on this topic where, I explain kind of in a comical way how the banking system works in kind of a funny, joking parody. If you want to check it out, I'll put it on the end screen at the end of this video so you can watch it. It's about 3 minutes long, and I think it really explains kind of what a scam the banking system is, right? But the bottom line is when you realize that the fractional reserve banking system means that your money is not in the bank, that you put your money in the bank and then the bank lends that money out to other people, and therefore the elevated interest rates, like I said in the last point, are leading to all these problems that are making the problem get out of control. Remember, back in COVID or pre-COVID, there were a lot of rules about reserves that the bank had to have for every deposit. The fractional reserve banking system meant that maybe they had to have 10% deposits or 10% reserves based on their deposits. If they had $1 million in deposits, they had to have $100,000 in reserves or something like that. But when COVID happened, they removed all the requirement to have reserves for the bank. So now you could have $1 million in deposits and the bank doesn't need to have any reserves. So what happens is when we have these issues, the problems spiral out of control, right? It doesn't take a huge loss and a huge downswing in the economy for these banks to spiral out of control when they have no reserves. And if they have no reserves, how can we really lean on them as safe financial institutions? especially when we think about the fact that they have no reserves. That's first. They've made poor investments. They've had slowdowns of new deposits. They have defaults of loans from borrowers. And what happens is all these these facts hurt all the banks, but the problem is it hurts the smaller banks most. And what's happening is all the local banks are gonna hurt the most, and it's gonna roll up. The FDIC is gonna come in, they're gonna roll it up, they're gonna put it to regional banks. Some of those regional banks are gonna fail, those are gonna fail. They're gonna get gobbled up by Bank of America, Chase, Wells Fargo. All these types of, the bigger banks are just gonna get bigger, and it's gonna create a lot of problems in the banking industry. And the worst part about this is that the ripple effect is gonna mean less access to services and capital for smaller local businesses, which are basically the lifeblood of our economy. And if we restrict the ability that those companies have access to capital, right? And we have to realize most of those local businesses, entrepreneurial businesses, smaller businesses, lean and leverage and depend on the local banks. And if those local banks get gobbled up in the ways that they have access to money change, then it's gonna change the entire dynamic of our entire economy. Now, the third thing to think about that I think is gonna lead to more bank failures is the danger in commercial real estate right now. I don't know if you know this or not, but there's about $1 trillion of commercial real estate loans that are set to mature. And these loans are gonna be renewed at higher interest rates than they are right now. What's gonna happen is this is gonna lead to a lot of problems. It's gonna cause probably a reduction in commercial real estate valuations. It's gonna mean a lot of people are not gonna be able to afford the payments, the cash flows of all these properties are gonna get turned upside down. And the reality is that the banks that have the most exposure to bank failure here are gonna be the banks that have the most exposure to commercial real estate loans and that also have high exposure to uninsured deposits. You know, the banks that have the deposits of people that are above the FDIC levels, right? The 250,000 plus or other deposits that are uninsured. When we look at Republic First Bank that just failed, they had a ton of commercial real estate exposure, and that's one of the reasons that they failed on April 26th. So I think when we look at the economy and when we look at the direction that we're going and really the fundamentals of inflation and the fundamentals of the fact that inflation is still over 3%, which is about over 50% higher than what target inflation is. I know a lot of people are excited that inflation is down to 3 whatever percent, and it's not at the 8 and 9% that it was a year and a half ago. And they're excited about that, but we're still so far away fundamentally from being at target inflation where the Federal Reserve wants us to be. And so when we look at that, we have a long ways to go, and we have to realize that it's the idea of reducing interest rates before we get to that 2% target number, which I don't see happening anytime soon, is going to lead to more banking failures. But that said, there's good news because while there's all this doom and gloom of people out there that are talking about banking failures and trying to scare you and fearmonger you. I'm not one of those people. I'm not somebody who believes like the sky is falling or whatever. I just believe in really thinking about making sure that your money is in alignment with your values and beliefs. You know, so no harm, no foul. You keep your money in the bank if you want. The reality is last year, less than 7% of depositors actually lost money due to a banking failure. So when it comes to that, mostly that happened due to consolidation and most people didn't get hurt. Their money had to transfer. Maybe there were some inconveniences and there could be some pain through that process. But at the end of the day, people, for the most part, got their money, right? 7% is a relatively small number when we think about the amount of banks and the amount of money that actually was in those banks that failed in 2023. And if this happens again in 2024, if we go back to like 2008 when hundreds of banks failed in those kinds of situations, if we have a repeat kind of reality of that experience, or even worse, which I think is really potential. The question is, where are your risks, right? And I think the risks are minimal, but what I would say is that there are some things that you should do, some things that you should really consider if you are in this situation. So the first thing that you want to do is to make sure that you keep your funds under the FDIC threshold, which is $250,000. If you have more money than that, make sure that you spread your deposits to other banks. Don't keep all of your money in one bank. It's good to have multiple banks. It's just diversification, and it's a smart thing to do. The next thing to do is to utilize whole life insurance policies as a place to keep your safe money to hedge from the fiat money system. What does that mean? Well, like I said, we live in this world where it's the fractional reserve banking system. So the fractional reserve banking system means you have to play in this fiat money system, which means we have this elastic currency. A lot of people are worried about the risk to our world's reserve currency status in the United States and the potential that we will lose that world's reserve currency status. And we're worried about what's going to happen to our banking system then, what's going to happen to the valuation of the dollars. And if you have your money, which let's face it, we got to play the game. We got to kind of be a part of that fiat money system for the most part if we want to be able to operate our businesses and run our financial lives. But the bottom line is we have to also think about what is the worst case scenario. How do I operate right now? I'm a big believer in having systems that allow us to, operate as is, but also protect us on the back end. If we have our money in the banks, and I'm not saying take all your money out of the banks, I'm saying spread it out, but also spread some and have some diversification into whole life insurance. And the reason is because whole life insurance companies have been doing this for 180 years. Their only job is to get the biggest, highest rate of return with the least amount of risk possible. Now, when you throw in that least amount of risk possible, it obviously puts a little cap on how big the returns can be, but we're talking about 4.5% to 5% from a long-term perspective. Historically, that whole life insurance companies are able to get their policyholders net after fees. And when we think about that, I know a lot of people don't like whole life insurance compared to an investment, but when we compare it to an actual savings account or a bank account, it starts to make a lot of sense, right? And then when we tap onto the fact that we look at how many hundreds of banks have failed since 2008, we're looking at almost 600 bank failures since 2008 alone, and that only one participating mutually held whole life insurance company has failed since 1840, that's a whole different scenario. That just goes to show that these whole life insurance companies are the most financially stable institutions in the world, and they do this, they pay dividends every single year, even in the down economies, and to me, that's where the power is. Now, where it gets really exciting is the risk against the loss of the world's reserve currency status in the United States, because here's the deal. If you go back to 1840, when these participating mutually held companies started, it was a different version of the dollar. And I've done a video on this. It is really, really powerful, explaining, and I'll try to put it on the end screen here so you can watch it. But if you go back to 1840, it was a different version of the US dollar. And then we go to 1870s, it was another version. And then in 1913, when we went to the system that we have it with a Federal Reserve, and I could even argue 1944 when we went and got the gold standard, and we became the world's reserve currency and actually had gold standardized notes. And then 1971 when we went off the gold standard. At the end of the day, most people didn't feel those changes because it was still the Federal Reserve that was kind of managing all the money. When they privatized the banking system in 1913 with the Federal Reserve, and if you haven't read the book Creatures from Jekyll Island, I would totally suggest everybody go and read that book. It's a huge book, but by G. Edward Griffin. It's an amazing book. I really, if this is something you're interested in, I would really suggest going to do it. But the reason I love whole life insurance as a place to save your safe, liquid, accessible capital instead of a bank is because if we hit a point where we lose a world's reserve currency status, right now, these companies, the whole life insurance companies, they've already proven they have the ability to pivot and change their general fund investment. It gives you the ability to operate in the current fiat money system, but it also gives you the ability to partner with one of the most financially stable, successful institutions that are managing billions and billions and billions of dollars, where some of the most successful people are keeping their money. A lot of the banks have billions and billions of dollars. Corporations have billions and billions and billions of dollars inside of whole life insurance contracts. So if you know that these people have it there, this is the money that when a pivot needs to happen, whether it's to a different digital currency, whether it's to a different type of currency outside, where if the US dollar becomes at risk legitimately, not just from a hype perspective, these insurance companies are going to be ahead of it. Before me, before you, before anybody else, this is what they do. And the people whose money they are protecting are the most important people in the world. So I want to put my money where those people are putting their money. So that's just my 2 cents. But I would say protect yourself from banking failures. Make sure that you have this whole plan kind of laid out. Make sure if you're thinking about, if you're a high net worth individual and you need to spread it out, I would really, really seriously give some thought to having a properly designed whole life insurance policy as a banking alternative, because you lose a very, very marginal, like we're talking 10% or less amount of liquidity based on how you're able to fund your policy and how you're able to design it. It brings in all sorts of other ancillary benefits. But at the end of the day, the whole idea is I think this is going to get worse before it gets better in the banking system. And how that plays out, I don't know. It may end up not being a huge deal for most people, but for the people that it does impact, if you fall into that category, it will be a huge impact. And at the end of the day, we don't know what the ripple effect will be on the world's reserve currency status of the US dollar. We don't know if it will make it stronger or make it weaker. Different people have different opinions about that. You talk to a Peter Schiff and he thinks it's gonna get worse. You talk to a Harry Dent, he thinks it's gonna make it better. And so what I know is nobody knows. What I know is it's all speculation and we won't know anything until it actually happens. So what I wanna do is I wanna have my money in a place where I know they're able to pivot whatever direction happens, whatever way we go. I know that I'm at least positioned with a company that is gonna be able to handle and manage that pivot better than anybody else in the business. So that's it. If you found value in this video, please like it, share it, get it out there, subscribe and hit the bell. That way you're notified every time I launch a new video. Hopefully you found value in this. Till next time, have a blessed, inspirational day. We'll talk soon. See ya.